Before you take out a loan for your business, you need to listen to this podcast first. Imagine having the ability to unlock liquidity right when you need it most without the headaches of traditional financing. That's exactly what we're going to be talking about today. Welcome to the Ecomm Breakthrough Podcast. I'm your host, Josh Hadley. I scaled my own brand from 0 to 8 figures in sales, and now my mission is to take it to over 9 figures. On my journey to 9 figures, I bring you unfiltered conversations with the smartest minds in e-commerce. Past guests include Kevin King, Michael E. Gerber, author of The E-Myth, and Matt Clark from ASM. Today, I am excited to welcome Mike Olson. He is a partner and founding member at Wellpoint, LLC. With over 25 years of experience in financial and insurance planning, Mike has dedicated his career in helping affluent families and business owners unlock clarity in complex financial decisions. He holds multiple professional designations, CLU, CHFC, CFP, and MSFS, and is a nationally recognized for his expertise in structuring insurance solutions that fuel business growth. In today's episode, we're diving into the powerful and often overlooked strategy of how e-commerce entrepreneurs can use insurance to fund inventory cash flows. Mike is here to share how these creative financing tools give Amazon sellers and online business owners the liquidity and leverage they need to scale sustainably from 7 to 8 figures and beyond. With that introduction, welcome to the show, Mike.
Thank you, Josh. Nice to participate.
Mike, it's great to have you on the show, and I'm excited to share this kind of like with the audience because for the last decade, I have heard about, life insurance and the infinite banking concept and the bank on yourself kind of concept. And there's a lot of go check it out. There are books, there are YouTube videos. I've heard it on numerous podcasts where it's like, hey, you need to make sure that you are the bank and you fund a big life insurance policy, and then you continue to loan against yourself. And every time, I looked at doing that, it just did not add up and it just did not make sense. And so what I love is that when we started working together with you over 5 years ago, you painted a very clear picture of for the first time, I understood why it made sense to actually build a little war chest and amount of money in a life insurance plan that would then allow me to leverage it for business use when I needed to. So with that, Mike, I want to dive further into this, but just for further context for the audience, this is all for entertainment purposes only. None of this is financial advice or recommendation. I am just a podcast host and some idiot on the internet talking. So consult your CPAs, your own wealth advisors, those that are experts. This is for entertainment purposes only. But Mike, tell me your experience. You've been in the life insurance world for a very long time. You've heard people pitching whole life, infinite banking policies. You kind of have steered us away from those whole life, infinite banking policies. And I would love for you to share the reason why with the audience and why what you do is so unique.
So I think that our industry, the life insurance industry, has very good marketers of concepts or strategies that they're selling. And with that comes a generic approach to a client situation versus really taking their personal balance sheet, cash flows, timing of cash flows, net worth, family dynamic, and then building the appropriate insurance design with all of those inputs versus, hey, just buy this. So I think there's a little bit of a marketing predatory issue going on towards entrepreneurs to use this concept. My challenge has always been the thought process of this insurance policy. We're going to put the money in and we're going to take it right back out and we're going to borrow it. And then we're just going to keep spinning it. I do believe insurance as this bank is a phenomenal strategy, but I think there's a couple caveats to that. One of those is let it build to create a war chest to use versus put it in and then take it out right away. creates more efficiency. And then 2 is, how do you build the right type of insurance policy to do that with? The generic kind of foundation from the beginning was using whole life contracts, and a strategy or a definition of fully participating non-direct recognition type whole lives was the original concept and strategy. I was at New York Life for about 10 years of my 30-year career where that was promoted. The challenge with the whole life structure is that the flexibility of timing of premiums, dropping of death benefit, all these different things you can do to create the most efficient life insurance policy. And when I say efficient, I mean the less the internal costs are, the more efficient your money is. So you have to do all these different things to build it to minimize that cost and structure. And life happens. So different timing of, you think cash flows are going to come in and they don't, or all those different things. You need flexibility in your policy to adapt to being a business owner, right? Not taking a paycheck for 6 months because you're paying employees and cash flows and those kind of inventory, like we're going to talk about today. Those kind of things. So I think the right structure, it fitting the very specific person's objectives and designing it that way. And then the last thing is rate of return. What's the largest rate of return you can get while still having a very, very, very conservative strategy, so that instead of getting a 5% return on your money, if you can get a 6.5%, right, over 30 years, that's a lot more money and a lot more growth. So I think the whole life kind of puts a governor on your potential your upside or your return that you can get over a long period of time. That can be millions of dollars depending on how you're using your insurance. So those 3 things have really changed my strategy of how do you really do this the right way.
Love that. Now, Mike, for our listeners that are maybe new to this concept, they're like, what in the world are we talking about? You're talking about life insurance. Wait, I'm buying insurance and then I'm supposed to put it into this account, and then you're saying it can grow. But then you're also saying I can take a loan against this money. So for our listeners that are like brand new to this concept of like, what are you talking about? A whole life insurance policy or life insurance and banking on yourself. Could you maybe break this down into let's make it easy for a second grader to understand what's going on here at play with this life insurance?
So the whole reason life insurance is even in this conversation is the life insurance chassis itself has tax advantages. So you can put cash value or premiums into the policy, and then that cash value can grow tax deferred. And then when you take a loan, you can borrow from your policy, pay it back or not, but that's an issue to have a conversation around. And then they just withhold the death benefit from they reduce it by the loan, but that's tax free. So in reality, it kind of functions like a Roth IRA from a tax perspective. In addition, depending on the state of domicile, there's creditor protection. So a lot of entrepreneurs and business owners love the creditor protected aspect as well as the tax wrapper that you get. So the theory is, you load up your policy with cash, it grows tax deferred, and then you can borrow from it for whatever strategy you're trying to implement in your business. It can be for real estate, it can be for inventory. You pull that money out, and those loans that you're borrowing from your policy are relatively low compared to the traditional banking world in a normal environment. Now, 5 years ago, different story, but in a traditional environment, the loan rates that you're borrowing from are less than the bank opportunities and other options, hard money lending and strategic alliances with Amazon, things like that. And there's flexibility on how you pay it back. So there's no control mechanism of, okay, I'm going to give you this money. Now here's how you have to pay it back. It's very flexible. So you're basically just using this insurance shell, this creditor protected shell, as a place to put assets into to create this war chest of money that you can use in the future and not have a tax consequence tied to its growth.
Yeah, I absolutely love that summary there. So let's dispel this. So now I'm going to apply this maybe into the e-commerce world a little bit so that the entrepreneurs can kind of like maybe just get your minds going of like how you might be able to implement this. So what Mike is saying is like, all right, let's say your business spit off some cash, right? You have some profit at the end of the year. Rather than just taking that money and saying, hey, let's go dump this into the S&P 500, right? Or let's go dump some money into my Robinhood stock account. You could do that and you could pick some winners in that stock account and you could ride a big wave, but you could also lose some money. But one of the unique aspects is that's not necessarily creditor protected and it's not tax efficient as well. So if I were to want to take that money out, right, I would have to sell the stock, right? We could also talk about, margin. We could talk about loans against your investments as well. That is a separate strategy. But what I think is unique about the life insurance policy is that it is actually tied to something. There is a death benefit. So for me, I'm going to go open up a life insurance policy, maybe against my wife, so that I'm the beneficiary of that. And then vice versa, she has one on me. So she's the beneficiary of my life insurance policy. And then what we're going to do is we're going to take some excess cash that we get, net profit from the business. I'm going to put it into this life insurance policy. And this life insurance policy, depending on how you structure it, which is why Mike is on this, there are different policies that allow you to participate in the market up into certain degrees. So, if the market's crushing it, maybe you could get a 10% return, but it all depends on the actual policy that you have and how that's written. But you get to participate in the upside of the market. And here's also what I love about the life insurance chassis. There are certain policies where it has either a 1% floor or a 0% floor. So let's say the market crashes and it's down 50% and you lost 50% of your money if you invested it into Robinhood stocks, right? But if on the other hand, it's in this life insurance policy, your life insurance policy did not decrease by 50% like the market did. You have that floor of 0%. So even on the worst year, your worst year is a 0% return on your money, not a 50% loss. And so you're perpetually growing that money and it's creditor protected. So let's say you sold something online and your butt got sued, right? And now they're coming after your personal assets. Well, they can't touch that depending on, where you're domiciled, right? Where you're living. There's different states and things like that. But that's a unique advantage. In addition to that, you're able to loan against this. The money continues to earn or I guess obtain interest and growth that is tax deferred. So if you are like, hey, I do want access to my money, you could go pull out that money. And a unique aspect of this is that if you take out that money, you're going to have a cost of the interest for that capital. However, another thing we'll dive into, Mike, is, all right, let's say the interest rate that they're saying, yeah, it's going to be 5% interest. However, let's say you're in one of those participating loan structures where you have the ability to keep your money or your policy value can grow with the market. So let's say the market performed well and you get a 10% credit, right? Well, now you've just arbitraged. Your money has now grown in two different places. You pulled out the money. The cost of capital is 5%, right? But then your policy value also grew by 10% at the same time. And so now you just arbitraged 5% of interest on that. So I wanted to just explain that in simple details for the listeners to say it is a place where you can store money that will continue to grow. And this can become like in retirement ages, right? Which is where a lot of people like leverage like a whole life policy is like when you get to a certain age, you can begin taking money out of that policy. If you're retired and not making any income, pull money out that's tax efficient for you in tax efficient years for yourself. And so it's also setting yourself up for retirement, because I believe, Mike, one of the biggest things like entrepreneurs get stuck with is like, we're always very optimistic, very overconfident in ourselves. And there's always going to be hiccups along the way. But if you're just constantly saying like, oh, we got all this net profit, either A, I'm going to go take vacations, buy a second home, or I'm just plowing all the money back into the business. I love that the life insurance chassis like almost forces you to save for your future retirement, and also builds a massive war chest that I would argue becomes one of your biggest competitive advantages in the e-commerce space, because you're now going to be able to access capital at what I would say is like one of the lowest costs of capital that you could probably ever find. It's truly like you're banking upon yourself. So Mike, I know that was like a mouthful. Correct me if I said anything wrong, or elaborate further on any of those topics.